All right, welcome traders to the Forex winning machine. This video, we're going to go over fundamentals of the markets. This is really important. I know you want to get to the setup, but we need to build a foundation of belief so you can understand why we're trading the way we are and why we're going to follow the rules so that you actually follow the rules so that you actually get good results. As always, we all paid to be here. Please don't just give away this to someone for free. If someone is interested, just refer them to me. Okay, so let's get into it. Before we look at the Forex markets, we're going to look at the risk investment assets to contrast so we can see how the Forex markets are different from other markets. So this is NASDAQ. What do we see since 1986? It's up 1,000%. So it's done a 10x gain. Why has it done a 10x gain? Now, I could pull up the gold chart. I could pull up the Bitcoin chart. I could pull up real estate property prices. I could pull up Bitcoin. They're all the same and they're all showing huge price increases. Why is this? And what does it mean? What does it mean for how you would trade it? So the reason is, first off, these are scarce investments or scarce resource. You cannot just make new companies as easily as you can print dollars. You cannot make Bitcoin as easy as you can make dollars. You cannot mine gold out of the ground as easily as you can just print dollars. So those scarce resources, over time, we'll come back to NASDAQ in a moment. Let's look at the M2 money supply. As the money supply increases, we see the same thing, right? The money supply is increasing over time since 1959. How much is it up by? Since 1959, the money supply was 326 billion. It's actually up 6,000%. So the point is that as the money supply increases, people like to invest in things that have staying power, that inflate less than the money supply. So first, it's a scarce resource. The second reason is cultural investment norm, especially in the United States. People have IRAs, people take leftover income and they invest them in the markets and gold and Bitcoin, depending on the character of that person, which asset they prefer, or if all of them. So it's normal to invest in them culturally. And then we also have a reason of why government support. So typically the government supports asset prices. And one of the reasons they support asset prices is because they own these assets themselves. They're bag holders. So how do they support asset prices? Various ways. If there's a liquidity scare that happens, they step in and they print money, like we see December and March 2020. Happens all the time, but they promote prices. So what does it mean if you're trading a risk asset? It means how do you want to trade it? Trade it to the upside, right? Long term to the upside. You can take shorts, but you're severely disadvantaged, right? Because of the scarce resource factor, because of the cultural investment norm, because of the government support, trading it long term to the upside is the way to go for risk assets such as the stock market, such as Bitcoin, such as gold. The problem we have, this is the monthly chart, is if we're trading it to the upside and we're not taking shorts, that's fine if we're investors, we want to make money, but you and me are here because we want to have an income and we want to make money every week, ideally, but every month for sure. So what does that mean for us? It means that every time, if we're trading long only, there's a red candle here. We probably didn't make money that month. We might not have lost money, but we probably didn't make money. So if you're trading these how they probably should be traded, you're not making money every month. You can make money every year, yes, but you're not making money every month. And the evidence is a lot of the best traders, the best stock traders, the best equity traders in the world, they don't make money every month. And it's okay. But for me and you, we want to make money every month. So it's a problem. Okay, now let's go from here. Well, you could make money every month in theory if you were also doing shorts, but you're doing shorts, the shorts are just super disadvantaged. They're going to cost you over time. So let's look at, say, Euro USD, for instance, instead. Now, keep in mind, again, we're saying the money supply up 6,000%. We're saying NASDAQ up 8,000%. If we were to look at gold, Bitcoin, we're going to see the same thing. Let's look at Euro USD on Awanda. What do we see here? It goes back to 2003. Let's see if we can get longer price history. FXCM, this works. Okay, let's go back as far as 1971. What's the most extreme move? 200%. 40%, right? 100%. So it does trend, but it's a much tighter band, right? It doesn't go 10,000% up, 10,000% down. And if we're to look at the yearly, the 12 month, what do we see is typically it just kind of chops back and forth, right? Doesn't appear to be going anywhere. Why? Why is this different? Why is Forex different from the the risk market, risk asset market? Well, one is it's paper money versus paper money. What does that mean? Well, Euro USD, they adjust interest rates versus each other, right? They're both monetary supplies are expanding over time at a similar rate. So there's no reason why one should go to the moon. Another reason is no investment norm. Nobody is investing in euros in their IRA. Nobody. There's maybe one person, but probably not. Like maybe in their self-directed IRA, right? No one is. People don't invest in foreign currencies. There's no cultural norm, and there's no reason as well, right? It doesn't make sense. There's no reason to do it. Now, the another reason is government intervention. So we talked about governments will intervene to support asset prices, but governments will intervene to cause reversals in the Forex market. They're trading partners, right? Trading partners want stability. They're allies. They're in cahoots with each other. They get together and they say, the foreign currency prices are out of whack. Let's get them back normalized. So let me give you an example of that from, let's go to my Twitter, from a book, excellent book on historical bubbles. This is all you need to know on the same page. So here they're talking about historically in 1987, the dollar was too weak against the yen. The yen was too strong. So 7 finance ministers, including the US finance minister and the Japanese finance minister, came together and coordinated a reversal. They coordinated a reversal. So government officials will coordinate reversals in the foreign exchange market and coordinate increasing the price in the stock market and asset market. And in the same page, it says down here that speculators were led to believe that the government would not allow the share price to fall because the government sponsored this IPO. And the share price later fell 4 years later, but the government did support it as much as it could. So this is all you need to know here. So what does that mean for trading the Forex market? What does it mean? It means trade reversals, okay? Trade reversals. This is our strategy. We're trading reversals when we'll get into the setup later, but when price hits old monthly highs. Now, every trade is a reversal trade in the system when trading Forex. Again, I'm a fan of trading breakouts on risk assets, but not for Forex because government will step in and intervene and stop the breakout. And the trend can only go for so long. So what does trading a reversal mean? Here's some principles. We're going to sell green. We're going to buy red. We're going to sell high. We're going to buy low. Okay? We're going to sell high at old high prices. We're going to buy low at old low prices. Okay? We're doing it on a higher time frame because we need time for the governments to intervene or whoever to step in as well. Trade reversal, it could mean limit orders. I'm mostly trading market orders, but it could mean trading limit orders. It means fading breakouts and even trading opposite of breakouts. Reversals, it also means we're not going for a huge reversal. So it's going to be a quicker TP. with no pyramiding. So we're not gonna, once a position starts going our way, we're looking to exit. We're not looking to add, because if we think we're gonna add and it's gonna run forever, it's not, because it's just gonna reverse again. So this is the fundamental of trading the Forex markets. Now, the beautiful thing though is if we're trading reversals, we get a reversal in a particular market almost every month, produces a predictable reversal. And we can trade many pairs that are uncorrelated. Most of the risk assets are correlated. If one stock market goes down in the month, they all go down. Probably Bitcoin and gold go down as well. Not always, but often. So we're able to take a lot more trades, and we're able to trade them predictably. We're able to scale, and we're able to do it in a way that makes sense fundamentally. So it makes sense. Risk assets, investment assets have an investment cultural norm. They're scarce, and the government support the prices. Paper money versus paper money is trendless. There's no cultural investment norm. Governments, central banks intervene to cause reversals because they're trading partners who want stability. So therefore, it makes sense to trade reversals on Forex pairs, selling big green days, buying red days at old high prices and old low prices, fading breakouts, and just taking whatever TP comes with no pyramid. And you can do this monthly and make money almost every month. So no guarantees, right? But let's get to it, and we'll see you in the next video. Much love.